Elon Musk paid a true tax rate of about 3.27% over several years. Meanwhile, a teacher earning $60,000 a year might pay closer to 20%. And here's the thing, both of them followed the law. I spent way too long being angry about this before I actually understood how it works. Turns out, the system isn't broken. It was built this way. And once you see the mechanics, you'll understand why the loopholes that work for billionaires are completely useless for the rest of us. Let's start with the most important thing nobody explains clearly. You and I earn money through paychecks. We trade our time for dollars. The government sees that money hit our bank account and immediately wants its cut. That's income tax. It's automatic. Your employer even withholds it before you see a dime. But billionaires? Most of them don't have jobs. Not in the way we think about jobs. Jeff Bezos doesn't get a bi-weekly direct deposit from Amazon. His wealth comes from owning things, specifically owning stock. Here's where it gets interesting. Let's say you bought stock in a company for $10. A year later, that stock is worth $100. You just made $90, right? Well, technically, no. According to the tax code, you haven't made anything yet. That $90 is what's called an unrealized gain, meaning it only exists on paper until you sell. And if you don't sell, you don't owe taxes on it. This is the foundation of everything. Billionaires don't sell their stocks. They just sit on them. Meanwhile, those stocks keep growing. Bezos might be worth $200 billion, but if he didn't sell anything this year, his taxable income could be close to zero. Now you might be thinking, okay, but how do they actually live? How do you buy a $400 million yacht if you're not cashing out? This is where the real magic happens. It's a strategy so elegant that when I finally understood it, I was genuinely impressed. And also a little furious. It's called buy, borrow, die. And yes, that's really what people in finance call it. Here's how it works. Step 1. Buy assets that grow in value. Stocks, real estate, art, whatever. The key is you're not selling, so you're not triggering taxes. Step 2. Borrow against those assets. Instead of selling your stock to buy something, you go to a bank and say, hey, I've got $5 billion in Amazon stock. Can I borrow $50 million? The bank says yes. Why wouldn't they? Your collateral is worth 100 times what you're borrowing. Here's the crucial part. Borrowed money isn't income. Let me say that again, because it took me 3 reads to believe it. When you take out a loan, the IRS doesn't consider that income. It's debt. You have to pay it back eventually, so there's nothing to tax. The billionaire now has $50 million in cash to spend. No income tax paid. Zero. Step 3. Die. I know that sounds dark, but stay with me. When someone passes away in America, something called a stepped-up basis kicks in. This means that all those unrealized gains, all that money their assets grew while they were alive, gets wiped clean for tax purposes. Let's make this concrete. Say a billionaire bought stock for $1 million 50 years ago. When they die, that stock is worth $1 billion. That's $999 million in gains that were never taxed. Now, their kids inherit it. But here's the twist. For tax purposes, the kids are treated as if they bought the stock at its current value, $1 billion. All that growth? Gone from the tax rolls forever. The heirs can then sell immediately and owe almost nothing. Or they can do what their parent did, borrow against it, live lavishly, and pass it on again. This cycle can continue for generations. Now, let me guess what you're thinking. Can I do this? Technically, nothing is stopping you from borrowing against your assets. But practically, this strategy falls apart for normal people for about 5 different reasons. First, the interest rates. When a billionaire borrows money, they get rates that are incredibly low, sometimes under 2%. Why? Because they're basically a sure thing. They have massive collateral. They're not going anywhere. When you or I want to borrow money, we get whatever rate our credit score allows. For most people, that's somewhere between 7 and 15%, depending on the loan type. At those rates, the math doesn't work anymore. You'd be paying more in interest than you'd save in taxes. Second, you need a lot of wealth for this to make sense. We're talking tens of millions at minimum. The fees, the legal setup, the financial advisors who structure these deals, they all cost money. For someone with $50,000 in stocks, The overhead would eat any benefit alive. Third, most of us need to sell our investments eventually. For retirement, for emergencies, for life. The buy, borrow, die strategy only works if you never need to touch your principal. That's not realistic for someone saving for a house or their kid's college. Fourth, banks don't offer these loans to regular people. The financial products billionaires use, things like securities-backed lines of credit with favorable terms, require minimum account balances that most of us will never hit. You need to already be wealthy to access the tools that keep you from paying taxes on your wealth. And fifth, the stepped-up basis at death mostly benefits people who have something substantial to pass on. If your estate is worth a few $100,000, you probably fall under the estate tax exemption anyway. The real benefit goes to those passing on tens of millions or more. So the loophole isn't really a loophole. It's more like a VIP entrance. The door exists, but there's a bouncer checking your net worth before you get in. And it's not just buy, borrow, die. Take charitable giving. You've probably heard that rich people donate money to avoid taxes. There's truth to that. If you donate appreciated stock to a charity, you can write off the full market value without ever paying capital gains taxes on it. But here's what that looks like in practice. A billionaire donates $100 million in stock that they originally bought for $10 million. They get a tax deduction for the full $100 million. They never pay taxes on the $90 million in gains. And often, the charity they donate to? It's their own foundation, which they control. The money doesn't really leave their orbit. For you and me, the standard deduction means we probably won't itemize our taxes anyway. Donating a few $100s to charity is a kind thing to do, but it's not moving your tax bill in any meaningful way. Then there are opportunity zones, special areas where you can invest money and, after 10 years, pay zero capital gains taxes on the growth. Sounds great until you realize you need serious capital to make these investments, and they're structured as complicated funds with high minimum buy-ins. Or real estate depreciation, where wealthy investors can claim their properties are losing value on paper even when they're actually appreciating. This creates losses that offset other income, but you need to own significant real estate and have the legal and accounting firepower to structure it correctly. Every one of these strategies has the same thing in common. They're technically available to everyone, but practically available to almost no one. The tax code is about 40,000 pages long. It's filled with provisions that look neutral on the surface but overwhelmingly benefit those who already have resources. That's not an accident. Wealthy individuals and corporations spend billions on lobbying every year to create and protect these rules. So, where does that leave the rest of us? First, don't fall for anyone selling you billionaire tax secrets. Those gurus charging $200 for a course are selling you information that either doesn't apply to your situation or is straight up illegal. Second, the strategies that actually work for regular people are boring but real. Max out your 401k contributions if you can. That's money you won't pay income tax on until retirement, when you might be in a lower bracket. Open a Roth IRA if you're eligible. You pay taxes now, but all the growth is tax-free forever. Use a health savings account if you have a high-deductible health plan. These aren't sexy. They won't make you feel like you're gaming the system, but they're the actual tools designed for people who earn regular incomes. And third, understand that the real conversation here isn't about finding better loopholes. It's about whether the system itself makes sense, whether we want to keep giving advantages to people who already have the most. That's a policy question, not a personal finance question, and it's one worth thinking about, especially during election seasons. The game is rigged, but not in a way you can unrig from your living room. The best move is to play your own game as well as you can, while understanding why theirs looks so different. If this helped you see the system a little more clearly, subscribe to Like Your 5. We're going to keep pulling back the curtain on topics like this, explaining the stuff that's deliberately kept confusing. Because once you see how things work, you can stop blaming yourself for not winning a game that was never designed for you to play.